Good evening, viewers. This is Sachin Maheshwari, your host for the evening. I am also assisted by Mr. Ashish Gupta. Both of us are the working committee members of RRC Delhi. Yeah. I hope you guys have been liking these webinars that we've been hosting now practically on a every week basis. Last week, we got a wonderful response on the POSH program that we did. And today, we have put across a wonderful program on wealth management and the succession planning. I think as business owners, all of us, are good in generating or chasing at least the wealth side of it. But none of us are, I would say, expert on the wealth management. And a lot of times, I think we're not able to give priority or sufficient time to wealth management and especially the succession planning. We also believe that this is one aspect that can probably be taken up in the later part of life. But I think the pandemic has really made us realize that we can't take anything for granted, and we must really plan our succession aspects, the financial aspects of those well in time. And I think if you would have seen yesterday's article on Times of India, it mentioned about how the number of people or number of especially the family business owners in the age group of 30 to 50s are now really going for putting up those wills, getting all their getting an audit done for all their financial assets to see if the nominations are in place, getting joint accounts done, trying to separate their some of the personal assets from the personal guarantees that they've given for business. So it was a wonderful article yesterday, very apt for today's session. And I think whatever doubts you have on that, today is the right platform for you to get that thing addressed, because we have two of the finest speakers from the industry with us. And it's my real pleasure to introduce both of them. So we have Mr. Atul Singh, who's the founder and CEO of Validus Wealth. He has a rich experience in private banking. And we also have Mr. Oscar, the Senior Vice President from Validus Wealth, who's taking care of the wealth and the tax structuring. He has over 13 years of experience in the field of taxation and especially on the succession planning. So over to you, Mr. Atul. I think the audience would be very keen to hear both of you and learn from both of you.
Thank you, Sachin. Thank you for the introduction and thank you for the opportunity to come here and speak to this audience on a topic that is very contextual in today's day and age. I would like to share a document. Sachin, is my document shared and visible to all the audience?
Yes.
Okay. So what I will do is maybe I'll spend a minute introducing our firm, and then we'll talk about the framework around wealth planning and wealth management. So Validus, we are a 4-year-old private client platform, but we have grown well and we have grown fast. It's actually a platform that came together with a lot of senior investment professionals from the private banking industry coming together, about 170 of us. And we actually invested time and energy in putting the right capabilities for serving Indian families, for managing their wealth, planning their wealth, both in India as well as globally. We built equity research platform, fixed income platform, alternatives platform, global investing platform, and the focus of today's discussion, tax and succession planning, emphasis on succession planning strategies. About a year ago, LGT Bank, which is one of a large private banking businesses in the world, one of the safest banks in the world, rated as top 50 safest bank, with credit rating of AA2, which is 4 notches above India sovereign, took majority stake in our business and provided a long-term stable capital for us to continue to build the business. So in a sense, we call ourselves the right combination of global pedigree, 100-year-old bank with steady source of capital, providing global platform, plus we are, as we kind of started with, we are a bunch of sort of Indian private banking professionals that, in a very entrepreneurial way, want to serve Indian families the way we believe Indian families should be served, because that's one area where pure global companies have actually failed. So a lot of Citibank and HSBC and Deutsche, I mean, they've all tried to run their businesses the way they run their global businesses, and not aligning the business to Indian family needs. And that's the gap we want to fill between combining the global capabilities as well as the local capabilities that we bring. So that's a little bit of about us. Now, talking about wealth planning and wealth management in post-COVID era is important, because, as Sachin mentioned, the COVID has highlighted the uncertainties that we face in our lives. We believe that we control many things, but these type of phases make us realize that we actually control nothing. And while we don't control nothing, but we can still be prepared to deal with those risks, right? So we are a strong believer that based on what we have seen, it is absolutely critical for us to really look at probably all our assumptions that we made about our life, about wealth, about our kids, their well-being, their lifestyles, etc. Many of those assumptions need to be relooked at and rechecked, and a lot of our planning, whether we did or not, even if we did, needs to be relooked at. And if we really didn't do a lot of planning to deal with uncertainties that life can throw up, we got to go back and do it. So just quickly moving on to how we think about wealth planning, right? I mean, what are the risks that you can actually not avoid. Risks are always there, but you can plan for it, that if the risk materializes, you are prepared to deal with it, right? So one sort of risk that we always talk about, and it's probably much known and spoken for, is, let's say if you're a earning member, and if there is sudden passing away a few of the earning member of the family, then that income needs to be replaced, right? And classic term insurance solutions, etc., are there. I don't think enough families kind of use that. I mean, this is something that every family should have. There is still significant gap. The penetration of term insurance is not very high in India. In fact, it should be higher, but at least well understood. People understand that they need to have life insurance, simple term life insurance, that if something were to happen as an earning member of the family, at least the family's lifestyle does not deteriorate. The second one is, okay, I mean, if you, let's say nothing happened to you, you're 65, 70, but you still have your income that you had either through your business or your job goes away. But you still have, I mean, life expectancy have gone up tremendously. So, you have another 20 years to live. Now, how to generate a regular and, more importantly, guaranteed income for life, right? So retirement planning, again, there are very, very good, efficient tools that are available today in our country. If you focus on this aspect as well, you would actually be able to plan for it. So, if you're anybody, and there I say that anybody who's in their 50s today, right, needs to, because you need 10 years to really sort of plan for it, right? So if you're at 50, you have another 10 years before you may think of retiring again out of your business or your job. That's sufficient time for you to plan for a guaranteed income for rest of your life, from 60 to whether you live till 85 or 90, at the rate where your lifestyle again does not get impacted, right? So again, the planning can be done if you really think about it in advance. Now, once you have, let's say you're taken care of the risk of the earning member passing away suddenly, then you have taken care of the risk of, okay, if I don't pass away, then I still need to feed my family for rest of life. So you kind of control that risk as well. The third is, after you, the seamless transfer of wealth to the next generation, right? I mean, as Sachin mentioned, all of you have worked hard, create wealth. But if you really didn't plan for a transfer of this wealth, transfer of your business as well as your liquid assets, a lot of that wealth historically is known that it gets frittered away. We call it, it goes to unintended beneficiaries, right? So if you planned for it well, it goes to the intended beneficiaries, which is your family and your next generation. So again, that's kind of the third level of planning that then one has to do and should do today. And again, something extremely critical in COVID era, where again the level of uncertainty that we all face has gone to a different level. And this is potentially our topic of discussion for rest of the time that we have with Oscar, going in detail on how to really think about transfer of wealth to the next generation. The fourth one is again very relevant for business owners. Again, thinking about uncertainties like COVID, making it more prominent. That and I'm a business owner running my firm as well, and I know that as a business owner, you take tremendous amount of risk in your business, right? So there are again planning and strategies that can be done, which actually takes a certain corpus out of your wealth, business, etc., keeps it on the side, and that pool can be made bankruptcy protected. So let's say if your business runs into uh, um, uh, tough weather, and there is the business goes down, etc., at least you have that pool that is completely kept aside. Nobody can reach out, the creditors cannot reach out to that pool, etc., etc., and that is good enough for ensuring the quality of life for your family, right? So these are all the uncertainties that you can't avoid, we all deal with, particularly as business owners. But the point that I want to make is that all of these can be, with very calm mind, you can actually plan for mitigating the risk. And I would encourage all of you to think about these risks and have a plan in place, so that if those risks come through, you're prepared for it, and ultimately the family's lifestyle does not get impacted. Now, in terms of wealth management, so wealth planning is one. Just switching over to wealth management, the wealth that you have today, the only way to sort of make it last not only your lifetime but your next few generations, is through, again, much used or abused word, asset allocation, right? So it needs to be managed well, in a manner where you diversify it enough so that you are not susceptible to business cycles or market cycles, as opposed to, let's say, all of your wealth was in your business. That's concentration. You can run into business cycle or market cycles. All your money, if it is in even any of these single asset classes like public equities or private markets, etc., you do run the risk of huge volatility, meaning it going up and down based on the market conditions. So the first message I would say is that it's very critical to really think about asset allocation. It's even more critical again in post-COVID world, because a lot of our assumptions about what works in the world has changed, right? I mean, what is happening with Fed easing rates like there is no tomorrow, printing money, the interest rates going down to near zero levels around the world, and very low levels in India. On the equity side, the businesses that have technology and healthcare component, they're running faster. Some of the businesses that have a lot of sort of offline old economy type businesses, they would struggle, etc., etc. So there is a way to kind of overlay the COVID thinking on your portfolio in each of these asset classes, but very critical to have a well diversified portfolio. Again, here we have put examples of, or let's say one sort of typical client who would have 50% in public equities, absolutely potent asset class in India. A lot of countries' economic growth and compounding through the company's earnings can be made use of, whether through direct equities or mutual funds or PMSs and AIFs with the smart managers. Target return of 12 to 15% per annum, absolutely critical to invest in the right manner. Like I said, all these the assumptions need to be kind of looked at a lot more with a lens in COVID era, but the asset allocation definitely demands allocation to equity. In today's day and age, what we have seen in the US first with the rise of technology, with one company being $2 trillion, three companies being $1 to $2 trillion valuation, and the top three companies having 500 billion on cash on their balance sheet. These are eye-watering numbers. Now, that rise of tech in the last 25 years has been the biggest sort of wealth creator for investors around the world. Now, Indian investors largely have sort of sidestepped that. Now, the way sort of this process is rolling on, that it started with the US, it went to China. China went through the same process of creating significant wealth for investors with the rise of tech there, and eventually India is going to go through the same process, right? So you see a lot of excitement about new technology-driven business models disrupting the existing business models and creating substantial scale, substantial valuations, etc. That those businesses are available today in private market. Not many of them, in fact, hardly any are listed. So that's why it's important to really keep an eye on small amount of money in those companies that are only available in private markets. The return, since the risk in private markets is slightly higher, so you control the allocation there, but the expected return on this pool could be higher. So again, and our team does a lot of work, particularly in bringing clients into a lot of these proven companies that are going to do IPO in the next 3 to 5 years, and create significant wealth. Third, on the fixed income, again, very peculiar situation today, where first in 18, 19, a lot of investors lost money in fixed income because they invested in mutual funds, and mutual funds invested in credit papers that actually went bad, and a lot of write-offs, etc. Now then the risk aversion sort of set in everybody. Everybody said that, hey, we will only invest in AAA papers. And then all the easing that central governments did around the world, but also in India, the yields went down dramatically, right? So today, if you invest in very safe mutual funds, you're going to get 3 to 4%, 5% return. Inflation is running at 5 to 6%, right? So what we call negative real interest rate is what you are facing when you invest in those mutual funds today. So there again, we need to look at various instruments. So, market linked debentures, MLD, very, very popular with HNI clients today, where we are able to generate 9%, 9 quarter on a very tax efficient basis, post tax of 8% plus, with shorter duration. So, 1.5 years, 2 years duration with very high credit quality. So, AA plus, AAA, almost AAA papers. Again, so that needs to be kind of, the assumptions need to be reevaluated there, and the money needs to be kind of rejigged to access the higher yield, because the inflation has gone up, and the yields have come down. So it's not a very comfortable situation there. Then there is a product category that is emerging in India, in HNI client portfolios. We call it market neutral strategies, where these products are actually uncorrelated to equity and debt markets. So because equity markets will have volatility, debt markets, the returns are lower, and there also the risk of interest rate moving is there. So these product categories, or this product category, actually sort of eliminates that risk and delivers 8, 9, 10%, irrespective of the movement of the market, right? So that's kind of well diversified. That's what a well diversified portfolio of an investor would look like, and would be ready to kind of take the shocks of the market. One additional point I will make is, which we have a very strong conviction on, that Indian families have to globalize. Again, another element of risk mitigation in a post-COVID world. The wealthy countries, US, UK, Europe, because of the strength of their economies, because of the strength of their currency, right? I mean, just US dollar being the reserve currency of the world, they have tremendous power. They can ease monetarily, fiscal stimulus, etc. And those companies comparatively do better, because if you think about Apple, Google, etc., that are innovation driven, but also the consumer companies like Coke and Pepsi and P&G, they're all global companies. They give you global growth, but they are domiciled in the US. I think Indian families have to allocate part of their money to an alternate currency, in hard currency, other than Indian rupee, because again, from a multi-generational point of view, Indian rupee will continue to have depreciating bias, and with longer time horizons, the risk of depreciation is higher. So again, our team does a lot of work in working with Indian families invest globally in a very risk adjusted manner, right? So if you allocated your assets in some parts in this framework, reasonably good long term returns, and potentially controlled risk because of diversification of asset. The last thing I will say is, again, very critical in post-COVID world. I will underline the last block of the three pillars that I talk to clients about managing their money on. The last one is, I mean, a lot of our families, a lot of you would relate to, lots of demat accounts, lots of folios, lots of other advisors. Sometimes your chartered accountant advisors, sometimes your insurance agent advises you, etc. But every such shock that we go through underscores the risk of risks that is embedded in a very sort of proliferated or very fragmented approach of managing money. So we strongly believe that having an aggregation of all your holdings, all your accounts, all your across all your advisors, ways you kind of manage your money on one place, so that you can aggregate all risk. Right, very very important. If you don't aggregate risk at one place, you cannot manage it when the shock comes. Right, so again, having a clean, reconciled, aggregated view of all your investments across the previous page I spoke about, including India and global. So in fact, for the families that we do global investing, we also bring that on a single statement, right? So extremely important. Only then you are able to do the right analytics and deliver the right advice. And then the final thing is on governance. So, do think about how you take decisions, decision making framework of how you take decisions. What are the guardrails that you really set for managing your money? What are the sources of risk? We call it investment policy statement. A lot of we insist that before families start investing, articulating that, and investment policy statement, nothing but maybe articulating asset allocation, and putting the guardrails that at no point I can't have more than 5% in small cap, or 3% in single A minus credit paper, etc. And once you set those ground rules, managing the portfolio, managing the wealth for a longer term becomes easier. And when the shock arrives, then you're able to really sort of deal with that, because everything is there in front of you, and you've been disciplined. Helps in managing the shock. So I will sort of stop at that in terms of the brief background. Again, I would make that assertion that if any of these components, either the components of the wealth planning or components of the wealth management, you want to go deeper, our teams are there, and will be very very happy to help you and take you through in our work in any of those. So with that, let me bring Oscar to talk in depth about the succession planning issues and the will, and how to transfer the wealth to the next generation, and potentially cover the risk of again, one of these uncertainties hitting your family. So over to you, Oscar.
Thanks, Adu. I'll just share the screen. So let me start with some sort of a study that we are doing in the market with respect to understanding the how much understanding the people have with respect to the succession law in India, whether they understand the concept of nominee, and whether they have a will in place or not. So study that we have done till date, though people understand the concept of nominee, but half of the people, they don't understand what the succession law is, what is the succession law talk about, what is applicable to them. And irrespective of that, more than 80% people don't have will in place. So it clearly states that people may understand that it's a priority that one has to do, but for some other reason they don't give importance to it. Now let me start why why one doesn't do a succession planning. Few reasons that from my experience that I can share is people think that I have made a nominee in my investments, right? So the succession will take automatically place. I don't have to worry about having a will in place or having some sort of a structure in place. People think that succession planning is only for super rich people. It's not for a middle class people or a small family, right? But that's not actually the case with COVID. It has changed the dynamic of the family. At times, people are not comfortable discussing either with the family or to the advisor. They are not comfortable sharing their assets or disclosing their entire assets to the family. So one has to come out with that comfort zone and start discussing that. At times, people think it's a very complex process to put will in place or put structure in place. There are a lot of laws involved in that, but actually that's not the fact. And at times people think it is the right age. I'm 30, I'm 40, I'm going to live for, let's say, next 40 years, 50 years, right? So people think it's not a right time to start have a structure in place. But with COVID, the things have changed, the mindset have changed. Even how people in 30s have started working on that structure. So if you ask me what is the right age, it's right now. Yeah? It's right now. The moment you have a wealth, the succession planning should be there in place, and you can keep revisiting that. Now, when you think about succession planning, the first most important thing that you need to identify is there a need for succession plan, or what is the objective for which you want to put a structure in place, right? So let me highlight few points over there. So one point is that if you want a seamless transmission of your asset to your family member or to a next generation as per your desire, right? So then you should plan for it. So if you, for example, if you don't have a will in place, okay, so basically you die without a will, then what happens is your succession law comes into picture. So if you're a Hindu, then Hindu succession law comes into picture. And as per the Hindu succession law, if a male person passes away without a will, the beneficiary, the class one beneficiary of his assets are basically the mother, wife, and children, and everybody gets the equal share. So you will understand that, let's say, if you have a mother, wife, and let's say 2 children, so everybody gets 25% share. So 25% of your wealth goes to the mother. Once it goes to the mother, you understand it will go to your sibling as well. Was it the desire that you want to protect your spouse or children, or whether it was the intention that even if you are okay to go with the sibling or not? So you need to plan for that. Some portion goes to kids also. So what is the right age that you want that the kid should have access to your assets? So that is something very important to keep in place, whether at the age of 18, 20, 25. So for that, you need to plan. Second, to address any potential dispute in your family member. So today you may think that, oh, it's me, my wife, and my one kid. There is the question of any dispute. You can't predict, or you can't even foresee what that dispute is. So let's say tomorrow, even if some dispute arises, if you have a structure in place, that dispute can be mitigated. So you can't predict what will happen. So it's better to have a structure in place. Now, third is basically if your children are minor, right? So something happens to both the parents now before the child turns 18. First important thing is that you need to appoint a guardian under a will, who will take care of the assets. Now, a guardian will have all the access to the to your assets, right? He can play around. You don't know whether he will pass on all the assets to the minor, okay, and whether your child will ask relevant questions to get access to all the assets or not, whether he will have understanding or not. So from that perspective, also you need to plan. If you have a special child, right? So special child, maybe suffering from disease, or let's say, for example, the child has autism, you will be taking care of his during the lifetime. But what happens after the lifetime? Because a child who is not of a sound mind, he cannot, he cannot sign any document. So after the age of 18, once the child is 18, the guardianship comes to an end. After that, you have to get a court paper to say that you are acting as a guardian for this special child. But what happens after the lifetime? Whether he's been taken care, whether any specific allocation has been done or not. So you need to plan accordingly. Also, your next generation is overseas. So if kids are overseas, whether they will have time to come down to India to the transmission of these assets, or whether they have time to manage those assets. So from that perspective, also you need to think. So there is also a lot of talk that in India the estate duty may be reintroduced. It was there, which was abolished in 1985. So the other developed country like US, UK, there is already estate duty in place. So estate duty is more like an inheritance tax. So if person pass away, on his wealth there is a estate duty. It's as high as 40% in the US. So there has been a lot of talk on this, but it has not been introduced. But many ultra HNI people have started putting a structure in place to address the estate duty. Now, if you're a business owner, you need to think from the perspective of protection for a family. So if you're a partner in a partnership, you are a director of a company, and tomorrow any liability comes, whether it's because of default in loan or whether because if you're a director, your personal asset gets attached. So even if you have read the recent article which Sachin mentioned, there is a recent Supreme Court judgment which has said that if a person has put a asset into a family trust, then you can go, the creditor can go behind the trust and figure out, the court can basically see whether that trust was created for the purpose of not fulfilling the personal obligation or it was for purely family planning. So it's always better to put that structure when things are good, right? So it's, for example, medical insurance. You never take medical insurance when you are hospitalized. You always take when you are good health. So whenever there is an emergency, that insurance can be applied. So you should always plan well in advance. So second last is basically ownership of your business. So let's say you own 100% in a company, right? It goes to second generation, third generation, and the shares of your company will keep splitting between the different beneficiaries. If it comes to, I've seen family where there is a fourth generation, fifth generation, everybody is holding 2%, 5% of the business. So the decision making is spread across the family, and you understand that third, fourth generation may not be in the same. So how do you control the 100% decision making is under one structure? So do you want to put that structure in place of this? It's important. Lastly is allocation of a business responsibility. So how it's more like a bylaw that one need to put into place how the business, because this is not something that you can address under a will or a structure, but having some sort of a family constitution, what does that say? So from that perspective also you need to put in place. I will run through various options. Now, when it comes to a pool of succession planning, okay, so what are the various options available and what is the best option available? So I will just run through that. So various tools that the people use is, one is nomination, second is joint holding, third is will, there is a family trust structure. I would say family trust structure has been of late has been taken. There has been a lot of trend that people start using family trust. Many people think it's only for ultra HNI people where the net worth is around 100 crore, 5 crore. It's not right. Even people with 5 crore, 10 crore can even set up a family trust depending upon the objective. So you need to identify what the objective is. And last is the having some sort of a bylaw, family or business constitution. Now, which options will address your the objective of your succession? So that is something we will have to identify. Especially the first three, the nomination, joint holding, and will, take place after the death of a person. Though joint holding give you access during the lifetime, but nomination and will comes only after the death of the person. Private family trust is during the lifetime. Even the business constitution is during the lifetime, which is effective. It is during a lifetime. We can say that structure is working. Okay. Now let me cover each and every option. And so first is nomination. So what is nominee? So nominee is basically what? You have a bank account, you have investment, you nominate someone. So something happens to that person, the owner of that asset. The asset is passed on to the nominee. So he is entitled to receive the asset upon the death of a person. But whether he is the absolute owner of that asset, answer to that is no. Many people think I have done the nominee, he is the owner of that asset. Answer to that is no. He is just a custodian under the law. Now, who is the legal heir? If you have written a will, the will override the nominee. And if you have not written a will, then in that case, your succession law will come into the picture. So whoever is the legal heir under the law will have access. We can claim the asset from the nominee. So why do we have a nominee? So it's basically just to avoid any delay in terms of access of the assets by the family. So from the financial institution perspective, they will always discharge the liability by giving that asset to the nominee. Okay. So it's always better to have somebody within the family as a nominee. So it acts as a stopgap arrangement between the financial institution and the family. And generally, when we work along with the family, we can generally ensure that the nomination is in sync with the will. So if you see a bank account or mutual fund, some may allow you to have only one nominee. Mutual fund may allow to have up to 3 nominees. So everybody has their own criteria. And nominee can be only a living person. You can't make a trust, your HUF or a company as a nominee. It has to be a living person. So second option is basically the joint holding. It's it's a very good option to have. Generally, what happens if husband is investing, you add your wife name as a second holder. Okay, it's a very good option for old age people, especially when something happens. The one owner, the second owner can have access to the asset, and that joint account is generally either of the survivor can opt it. And especially for old people, we generally also suggest to have one account if they are comfortable enough to have with the children also. Because at times of emergency, let's say you have a will where you said everything will go to the son, but let's say in case of emergency, the person is bedridden. How will son have access to the cash that is lying in your account? How will he spend that money on you? The bank will not give money to you. So it's always better we suggest for senior citizen or the very old people to have one account with the children where they can have access to the cash. Whether the joint owner become the absolute owner of the asset, answer to that is no. It's just that from the transmission perspective, it's very smooth, except in case of real estate, where people buy real estate, husband buy the real estate, adds wife name. And if you have not mentioned the co-ownership in that agreement, then automatically under the Transfer of Property Act, the ownership is 50-50 under the law. Okay. So in case of joint ownership, also the ownership always left is wedged with the legal under the will or the succession law. Okay. Now with that, I will come to the third option, basically the will. Now, what are the key essentials of a will? So the way the will is defined is, if a person is writing a will, he puts his wishes or his desire, okay, how his property should be dealt with after he not being there. So who should be the beneficiary? What are the assets? How should it dealt with the executor? Now, who can make a will? So there are criteria. So not everybody can make a will, but the person who is a major, so basically above 18 years of age, and should be of a sound mind. So lunatic person or a person who is not of a sound mind, he cannot make a will. So he should be of a sound mind, and he has written a will with free consent. So somebody comes and put a gun, or a family member gives you say that I'm going to put everything into my name, otherwise I'll do suicide, or I will kill you. You write a will. Okay, you write a will. So that will is not valid because you have not done with your free consent. So if something happens, you write a will. Next day morning, you again write a new will. Absolutely okay, because you can revoke your will anytime, any number of times in your life. So if something happens, right? Next day you write a new will. Absolutely okay. Now, under the will, you have a complete discussion how you want to deal with the property, whom you want to give it. Even if you don't want to give even if you want to give something to a charity, absolutely okay. You can give substantial part of your charity if that is the objective. That should be captured, because if your intention is to give your charity, and if you have not written a will, then the succession law doesn't say that it will go to the charity. Then the legal heir will deal the way they want. Okay, it's better to make a will at an early stage. Okay, not wait for that. It's only applicable for people who are about 60. It's not that. Life is very uncertain. Nobody knows their expiry date. So it's always better to write a will and keep reviewing it at a regular interval. Now, many people may have assets offshore also. So it's not necessary to have a separate will for offshore assets, but wherever you are investing, let's say in Singapore or US, you need to understand what is the law in terms of transmission over that. So like in India, there is a nominee concept, right? So asset passes to the nominee, so I have access to it. But in most of the overseas countries, there is no concept of nominee. Okay, so generally, we suggest that you open in a joint account name, and have a will, maybe depending upon what the process of probate is there, how the transmission happens. Have a separate will for that specific country, because that process is faster. Otherwise, you have to get the will probated and take it overseas, which is a time-consuming process, and make it detailed as possible. So you can mention about yourself. If you don't want to give something to some beneficiary, specifically state that why you're not giving it, right? So these are the key essential of the will. With that, I will quickly cover what are the things that should be mandatory there in the will. So detail of the testator is name, age, address, religion, identification like PAN, Aadhaar, so that clearly identified who is the person writing a will. Your will should always be dated. Now, if you're writing it today, it should be 12 June 2021. Because if you have not written a date, then it becomes invalid, because nobody will come to know when it was signed. You need to give a declaration that you are of a sound mind. You are writing this will without any, there is no undue influence on you. It's free of coercion. Obtaining a medical certificate, generally, we suggest if a person is very old, and if you foresee any dispute in the family, then we suggest to have a medical certificate, a doctor certificate, which says that you are a sound mind, a fitness certificate, so that tomorrow if somebody wants to challenge it, it cannot be challenged that he was not of a sound mind. Okay. Capture all the specific properties. Identification of the property is very important, like real estate, demat account, who is a relationship manager in terms of who is managing your assets. So that property is clearly identified. Value may keep changing, that's absolutely okay. Today you may be holding certain asset, you may sold off, it's absolutely okay. But identification of the property is very important. You should clearly mention under the will who are the beneficiary under the of a particular asset. So that should be clearly, you can mention the beneficiary waterfall is something. So sometimes it happens that husband said it will go to my wife, but if wife releases me, then it will go to my children. So you can mention the waterfall, and it should be very clear. There should be no ambiguity as to who are the beneficiary in that case. You need to appoint an executor under the will. So executor is basically a person who will take all the necessary steps to take effect the will. Now, so let's say in certain state like Mumbai, Tamil Nadu, and West Bengal, the probate is mandatory, right? So the executor, it's a executor responsibility to get the probate done. He will appoint the lawyers. He will take the will wherever it's required to be taken and ensure that the distribution has happened as per the will. So if there is any income tax, the executor will ensure that from the estate the income tax has been. So executor is more like a administrator when the company gets liquidated, more or less the same responsibility. Most importantly, the will should be signed, and it should be signed in presence of two witnesses. And those two witnesses can be anyone. Okay. If you ask me whether it can be beneficiary, let's say your wife or children. So there is no restriction, at least under the Indian law, Hindu law. Hindu succession law doesn't restrict that. Under Indian succession law, which is applicable to Parsi and Christian, yes, the witness cannot be the beneficiary. But under Hindu law, yes, but we generally say it should not be a beneficiary because of any dispute arising. There could be conflict of interest. So we say don't make beneficiary as a witness. It can be your advisor, your neighbor, whoever, other than the beneficiary. Some myths quickly I will run through. Few people think that it should be on stamp paper. No, it can be handwritten. It can be on plain paper. No need of stamp paper or any stamp duty to be paid. Will can exclude near relatives. Yes, you can. All your relatives can be excluded. You can say it will go to charity. It will go to your servant, friends, wherever, and you can even put my name. Absolutely okay. Whether nomination prevails over the will, we discuss this. Yes, will prevails over the nomination. Okay. Whether will should be registered, it's optional. So it's not mandatory to register a will, but there are certain benefits. People think that one, if tomorrow if any dispute, the will, it cannot be challenged in terms of genuineness. Genuineness in the sense, I would say the will was not tampered or modified. Someone has paid the bill. So copy can be always be taken from the registered copy, a certified copy in case of this. So registration gives you some benefit. You can even think of doing it notary. Okay. Notary gives you the same benefit in terms of will is not being tampered. Will can be modified or changed. Yes. No. So will can be modified. Let's say tomorrow you purchase new asset which is not part of your will and it has to go to a specific beneficiary. You can make a codicil, which we call an amendment document. It can be a one-pager, which will act as a modified document to your original will. Or if you have substantial change in the assets and your thought process, then you can even write a new will. Absolutely okay. Nothing stops you. Is there a legal format of a will? No, there is no legal format of a will. Okay. It can be in a plain paper, capturing the key essential what we discussed should be there in the will to make it valid will. Doctor certificate required. We discussed this. No, it's not mandatory, but recommended in some cases. Now, what are the drawbacks? I would say scenario where will may fail, okay, or it may not work appropriately as per the succession clauses. The will comes into effect only after the death of a testator. It doesn't during the lifetime. It's just a piece of paper. Okay. If it is not written properly, then it can be void. If it's not drafted, if there is any mistake, okay. So if you have not taken the help of an expert, if you want to write it on you, and if you have not taken care appropriate, it may be considered to be a void. It can be a subject matter of dispute. The major dispute comes because if you have not educated to someone, they will say the person was of not sound mind. It was drafted because of undue influence. From that perspective, there are a lot of disputes. Will is tampered? It is not genuine. It's not a last will. You have a limited wealth planning for the minor. We discuss about it because at the age of 18, the person becomes the owner of the asset, and whether you need to think whether the 18 age is appropriate to understand whether the kid should have access to the money or it should be at a later stage. will has to be probated in certain circumstances in certain states like Bombay, Tamil Nadu. So will, and it itself take around 6 to 9 months to get the probate done. So if you want to avoid that probate, you should think of alternate structure. If your beneficiary, the next generations are in overseas, the transmission process is cumbersome, and that person will have to be physically in India to get the transmission process done, to get the signature done, and even the management of those assets. It may become a tedious job for them. Will may not work in case of disability or termination. So as I said, if you are bedridden, how will family have access to the cash? So that's a major challenge which comes. And in case of business people, there is no protection of the assets. So any claim coming on you, you are owner of the assets, all your personal assets can be attached. And if you have not put a structure in place, the family would be in problem. So you need to put some sort of a structure in place. And lastly is the estate duty. So will not protect the estate duty if it is introduced in India. So with that, I will go to the structure where most of the drawbacks of the will can be addressed. So in trust structure, there are 3 parties. And this trust structure is purely a confidential document or confidential structure which is between the family. It's not something like a charitable trust structure, because many people think that get confused that when we talk about family structure, is more like a charitable organization where beneficiaries are public in large. Is not. It's a very, very confidential document which remains within the family. It doesn't have, nobody else have access to the document except maybe you have submitted into the bank or opening of demat account. That's okay with the financial institution, but otherwise nobody will have access to these documents. So in trust, there are 3 parties main. One is the settler. Let's say you settle the trust, you are the main contributor who set this trust. Who are the beneficiary? It can be a family member, and it should be a family member to avoid any tax implications. So let's say husband set up a trust for benefit of wife and children, so they become the beneficiary. And who can act as a trustee? So trustee is a legal owner of the asset. So everything, let's say Sachin is acting, Sachin has formed a family trust. So Sachin is acting as a trustee of that trust. So it will be Sachin Maheshwari on behalf of Maheshwari Family Trust. Okay, so all the asset is registered in the name of the trust. He's a legal owner, not the beneficial owner. He's a legal owner of the asset. He will administrate or control all the assets. But the benefit of the trust, the corpus that has been contributed in the trust, would be enjoyed by the beneficiary. Income would be enjoyed by the beneficiary, or it can be utilized for the purpose of the beneficiary, not for the trustee. Trustee is just an administrator of that trust. So you can contribute all your financial investment into the trust. With respect to the property, during the lifetime, if you want to contribute the real estate to the property, there is a stamp duty implication. So generally, we suggest if you are not comfortable with paying stamp duty, it can come under the will. So under the will, there is no stamp duty upon inheritance, whether it goes to the trust or to the family member. That we come to the part of what are the type of trust. Okay, so from the settler perspective, who is the main contributor to the trust, there could be 2 types of trust. One is revocable, and second is irrevocable. So revocable trust basically means you don't give up on the control of the asset or the ownership of the assets. Okay, you still control to own that asset. You can recall the asset. You can continue to earn the income from the asset. So especially in a family where you have earned the money and you are in a stage where you are going to retire, you want to spend some money on you. So you will create a revocable trust structure. Irrevocable, but irrevocable structure is basically where you give out complete ownership on the assets. Okay, so there could be specific reason why you create irrevocable structure. Let me speak about asset protection, estate duty. From that perspective, maybe people may create irrevocable structure. And how much do you put into irrevocable structure is always a matter of discussion with the family. Whether you are okay, let's say you own 100 rupees. Out of 100, whether you want to put 2%, 5%, how much is a matter of discussion, which we can be discussed, because not every person may be completely comfortable to give complete ownership on the assets. So from the beneficiary perspective, it can be a determinate trust or an indeterminate trust. So determinate trust says that the shares of the beneficiaries are identified. So let's say you create a trust where you say wife and 2 children are beneficiaries, so everybody will get equal. So 1/3, 1/3, 1/3. So it's a determinate trust. So beneficiary is aware what is their share in the trust. But in case of indeterminate trust, you don't describe. You say your wife and children are beneficiaries, but you don't say how much, who will get how much. And you leave that discretionary to the trustee. The trustee will decide who should get how much. Okay. So if you ask me in terms of asset protection trust, we always say it should be irrevocable trust structure and indeterminate trust. So it gives you a double protection. One from the settler perspective, who has contributed the asset. So if there is any claim, this money cannot be touch, but of course it will go into intention as to at what stage you have created that structure. And even from the beneficiary perspective, tomorrow if son goes to business and there is a claim comes on him, whether his shares can be attached, answer to that, no. The trustee will say, I don't want to make any distribution to the beneficiary, to that person, to my son. So his share is not defined. So trustee will take that decision. So it gives a double-edged protection in terms of irrevocable indeterminate trust. So most of the time, people will create that structure for asset protection. Now, what are the benefits? We discussed this in details as such. So, in case of child is minor, you can define at what age they should get. Now, not at 18, but at the age of 23 or 25, they will have access. But till that time, you can make a distribution from the trust with respect to their education expenditure, welfare expenditure, marriage expenditure, postal expenditure, whatever you want to mention, you can mention that with some distribution for meeting that pocket expenditure. It gives you a lot of flexibility in terms of how you want to make a distribution to the beneficiary. The waterfall can be defined. Asset protection, we discuss how, and it's very critical in today's world. And after that Supreme Court judgment, many people have started visiting the lawyer to understand whether that asset, whether the structure that put into, whether it's free from any claim that may come in. Because in IBC, most of the creditors are going behind the family trust law. Now, it also gives you protection of asset in case of family dispute. So let's say, for example, you have created a wealth. From you, it may go to the next generation, let's say to your son, right? So if you don't have a trust structure in place, you have a will and everything devolves to your son. Tomorrow, if there is a dispute between your son and your daughter-in-law, so daughter-in-law can ask anything from the son's property, even the property which he has inherited from the father. It becomes a very difficult time. So if you have put a structure which says that your son is the beneficiary and your daughter-in-law is the beneficiary till the time she is with the family, if she separates or get divorced, then she won't get anything. It's your asset, you decide who is the beneficiary, who can be added as a beneficiary, who can be removed as a beneficiary. You can define a pool of beneficiaries. It's a very good point. I'm just taking one example of family dispute. There could be many other things also. Estate duty also, it works beautifully if it is a irrevocable discretionary trust. Especially if your next generation is overseas, how do the transmission happen? How do those people manage the asset? Especially this works very beautifully if your children are in US, because you need to consider the US tax implication also in terms of when they inherit the asset, what are the US tax implications? Because the person who is a US person has to pay tax on their global income, so it may become burdensome for them. So many family actually, people who have gone there, they may say, I don't want anything, or put into a different structure, because it becomes a lot of reporting requirement for them in the US. So from that perspective also, you need to think how you want to put that structure into place. And special child we spoke about, if you want to make a separate allocation, during the lifetime you will take care of the special child, but what happens after the lifetime, whether the other sibling of that person will take care or not, whether they will think it's a burden or not. It's always better to have some allocation to the special child, from which all his expenditure with respect to his medicine, welfare, everything is taken care from that structure, so that financially it doesn't become burden on anyone. And there is a people who will take call on the as a trustee who will take call in terms of how the money should be spent on them. Now, just to do a quick comparative analysis on the three options, will, revocable trust structure, and the irrevocable trust structure. The asset and the credit protection, it can be done only under irrevocable trust structure. The will and revocable trust structure doesn't it, because you still are the owner. Legally, you are an owner of the asset under the will. Even under revocable structure, it's a revocable structure. Though you don't give on the ownership, you are in control of the asset. So you don't get the protection under for any claim that may come on you, or if there is any personal liability that may come on you. Irrevocable trust structure, if you do well in advance, then yes, there could be good argument to make that yes, it is protected. Flow of estate to next generation. All the three options can be used in that way, the way you want to draft it, put into place. Court-related progress, under the will, as I said, in certain state, or if you have not put a nominee, you may have to get succession certificate. In that case, it may become difficult. In trust structure, you don't have to worry about court-related progress, because in trust structure, there is no transmission happening. It's an automatic transmission. So something happens to the settler or to the first generation, the asset moves to the second generation. So if you have grandchildren, they are automatically added as a beneficiary if you want to define it in that way. So from second generation to third generation, it lies under the trust. There is no change of ownership of the assets happening. There is no question of any nominee to be done. In terms of estate duty, we spoke about, only the irrevocable trust structure will take care of it. Dispute, will is always subject matter of a dispute, but in case of trust, whether it's revocable or irrevocable, the dispute always gets reduced. Ownership of the asset, more from the settler perspective, you continue to be the owner under the will and the revocable trust structure, and it works exactly opposite the first point of asset and protection. You are the owner, that's the reason the credit protection is not there. In irrevocable structure, you gave up the ownership, that's the reason there is a credit protection. Now, last, basically a business and family constitution. This is more used by the many people have started putting into place, because when there is a first generation, they understanding, even the second generation they understand, but the moment it goes down to the third generation, when cousin comes into play into the business, then few disputes start arising. So that is always better to have some sort of a family constitution into place. This work like and I would say a bylaw for the family, and at some way you have to make it as a binding document within the family also, because this is not something which is under the law, it's more between the family. So family constitution specifically should contain your mission statement, what is the objective of the family, who are the founders, what is their thought process, what is the, you put some sort of a guiding principle, what the family should follow in terms of the business, how the ownership of the family business would be done. So let's say you have a daughter, she is not interested in the business, she goes marries other business family. If she wants to exit, how do you give that exit mechanism into place? So that should be something into the place. The confidentiality agreement, so it should not happen that the people in the family go and discuss all these things. So whoever is the party to that family should have a confidentiality agreement to say that the information with respect to the family is not business or other things is not shared with the other people. How do I to make a decision making process? And this is very important, the decision making process, because the moment it goes to second and third generation, how the decision, whether it's majority, whether unanimous, you want certain decision to be taken unanimous, certain decision can be majority. So there could be some people who may object. But even if that person is objecting, he may have to go ahead with the decision because majority people have taken that decision. So that decision making has to be clearly defined in that bylaw. Dispute resolution is tomorrow's any dispute. How do you resolve that dispute? Whether you go to arbiter, whether you go to court, how do you resolve the dispute within the family? Is very important to be captured. And you should clearly define the division of work, the segregation of the members. Basically, if a person is coming into the business and he has completed his higher studies, he went to overseas, did his studies, and now he wants to join the business at the age of 23. Whether you want to make him directly a MD or a senior person, so you want to evolve him along with the business. He takes the senior position at a later stage. So he gets that experience before he takes some sort of a responsible position within the business. So you need to define all those things. So it's more of a bylaw within the family. Couple of slides which quickly I will cover is, Atul spoke about the offshore investment. So if your next generation is overseas, okay, or even if you're planning to send your kids overseas, for higher studies, you need to understand that the rupee is a depreciable asset. Today it's trading at 73. 10 years down there, it may be like 4% depreciation if you consider it maybe at 90 or 100. So if you want to secure some sort of a dollar asset, today you have a window. The Indian resident can remit up to 250K per person per financial year under RRC. So this include all gift, investment, travel, and everything. So you can use that window every year to do offshore investments. Okay. Second, if any of a family member is NRI, or if you're planning to, somebody is going for higher studies or becoming NRI, the NRI person can take $1 million from India per financial year. And if somebody is inheriting some assets from India, that person can take up to $1 million irrespective of the wealth. But if that person wants to take more, then that person will have to make a application to RBI. But RBI will give there is no standard process in terms of whether RBI will give that approval or not. So at RBI discussion, whether they may or they may not give the approval. At the same time, you need to factor that if your next generation is in US and UK, they have the estate duty in place. So let's say if you are an Indian person and you invest in US, so the estate duty in US for a non-US person having US asset is only, the limit is only $60,000. The exemption limit is only $60,000. So if you own any asset above $60,000, that would be subject to estate duty of 40% in the US, even though you are not a US person. Okay, this happens with most of the IT related sector where they get the ESOP of the US company, or somebody has gone to US and start something in the US. So you need to just be mindful of that. In UK, the limit is around 325K. Okay, so you just need to be mindful in terms of how this, you need to factor this in your succession planning. So how does Validus help? What we do. So because we are a wealth management company, but as Atul said, we don't only deal with the investment, but we work along with the family to put a structure in place so that the transmission is in a smooth way. So we help them we discuss with the family, we identify the need and what is the objective. It's not that we just write a will. What is the objective? Whether will is right, whether trust is right, or we need something more than that. Right? So we identify those need and objective estate planning. We prepare them for a succession planning. Okay. We evaluate the most suitable option. Whether it should be will, trust. If it is a trust, what type of trust? Whether it should be revocable, irrevocable, and understand the consideration of tax, the regulatory aspects. And what we do is we bring in that, depending upon the complexity, we bring in the expert. So we have tie up with most of the law firms, accounting firms. We bring in those experts who understand that matters and help us to identify what is the best way of doing it. Right? And we implement this structure, whether it's will or trust, with the help of the expert. We work end to end with the family as well as the outside service provider to put that structure in. And then we keep reviewing those structure on a regular basis, whether it's will or a trust. That's how we engage with the client. Of course, there would be some cost, but we discuss the cost at the appropriate level with the family. So, Sachin, with this, I will leave the floor for the question answer session. Somebody has any questions or specific things to be answered, happy to do.
Yeah. Thank you, Oscar, and thank you, Atulji. Wonderful session. And I think too many inputs. And I think everybody listening has its, unke sabke apne parameters hain. So, I think so much of information that you've shared, people must be building around in whatever, context, each of them fall into whichever category they are. So, so I also request all the, guests on the show, if they have any questions, they could put on the chat box. We'll be glad to take it. There are a few questions that I would, put it to you, and I think depending on whoever is comfortable between you, Oscar Ji or Atul Ji can answer. So, first question that I would like to ask is that we were talking in the initial part about, nominee and will. So where will overrides the nomination. That is what is my understanding. I don't know whether I'm correct or wrong. So if you can just tell me I'm correct or wrong. But my question remains, so what happens to the nomination done on the life insurance policies people take, where there is a nominee held, is named there in the policy, and this becomes effective only on the death of the person. So is it going to be superseded by a will, or the LIC policy nomination is de facto the end of the document?
Yeah. So it's a very good question, Ashish. So there are two parts to it. If it is a purely nominee, yes, your will override the nomination and the LIC. Okay. Second is when you have taken a LIC, there is a one single form that you have to put, Women Protection Act, Working Women Protection Act. If you fill that form which says that the asset, the proceed from this insurance policy will go only to my wife or to the children, then it will go only to them. The will not override in that case. It also have a good protection in case of asset, and if there is any claim on the testator, the person who has passed away, if there is any claim, the creditor cannot claim from the life insurance proceeds. He can claim from any other asset that he owns in their personal name. But the asset which goes under the RIC, if you have put and fill that one form while you are taking that life insurance policy, we call it Women Protection Act, Working Women Protection Act. Then yes, your wife and children are protected. Even that LIC money cannot be attached by the creditor. Otherwise, your will always override the nomination even under the life insurance policy.
So some person dying, intestate without leaving a will, and there is a nomination on the LIC, can the other benefactors under the Hindu Succession Act challenge that LIC nomination?
Yes. Absolutely, unless that person has filled that, as I said, a specific form where the wife is protected. If that form is not filled, your will override the nomination.
Okay. So I also request Sachinji, I think me being on the phone, maybe I have a little less access to some questions. If you can be on the backstage and you have other questions, maybe we can. I still will take one or two more questions before Sachinji, So we talked about succession planning. So is HUF one of the options for succession planning? We did not talk anything about on that in the whole process.
Yeah. So I didn't speak about HUF because HUF is not a succession planning tool. That's the reason it's not there in my presentation. See, HUF was brought into, the law was brought into India basically for the protection of an asset for the family, to the wife and to the children. Okay. But people started misusing that because under the IT Act, HUF get that fresh slab of 2 lakh 50, 5 lakh, 10 lakh. So people started using HUF structure more from tax planning perspective. So somewhere in 1967, I believe, what people used to do, let's say father has set up with the HUF. When son comes, son has his own family, they should make some distribution from HUF, give it to the son. Son set up a new HUF. So they use it as a tax planning tool. So law came and they said the partial distribution of the HUF is not recognized under the IT Act. So if father make any distribution from HUF, it will be still considered that the HUF is holding the property. Now, so partial distribution is disabled in the IT Act. So even if you want to do a partial distribution, if you can do it, but from the taxation perspective, it will create more complex because it will be considered that the HUF, the father HUF, is holding that asset. One. Second, from the law perspective, if you see law, let's say if husband is putting the creating a HUF, so wife is a member. My wife is not a co-partner, and there's a difference between a member and a co-partner. So wife is a member, and your children are co-partners. So next generation is a co-partner. So co-partner has the right to ask for the partition of a HUF. So once they become 18, they can always come and say that, okay, there is any dispute. They can always come and say, I need a partition of this HUF. I need my money. So it doesn't work for succession planning perspective. So it can come at any stage, right? You can't predict those things. So if you ask me, HUF, yes, it's a good tool for tax planning. Have some minimum investment of, let's say, 50 lakh once year, where you want, let's say, 8 lakh, 10 lakh, and you save on some tax, but not from succession perspective because of all these criteria. And couple of years back, just to tell you, there is a white paper which is still on a draft page, a law commission paper which has come, which has recommended that the HUF law should be abolished. Reason being, people have started misusing, and the objective is completely defeated. So people have started misusing, and they have recommended that it should be abolished. So we never recommend to have HUF as a succession planning tool. Have a trust structure, whether revocable, irrevocable, and at the same time make it discretionary. So that works very beautifully from succession, not from HUF doesn't.
So moving again back from here to, we talked about succession, nomination, will, and so I have seen that even if you get your...
Okay, Ashish, we can't hear you.
Yeah, just one sec here. Can you hear me now?
Yeah.
Yes.
Yeah. So in terms of succession, will and nomination, I still see that people ask for relinquishment, even though when the will has categorically defined that A goes to 1 goes to A and 2 goes to B and 3 goes to C. Why is the relinquishment so important?
Relinquishment in the sense you are giving up the right in that property, right? The other beneficiaries are okay with that, right? See, what happens is, I will tell you, let's say one person has said that my asset should go to only to the son, nothing to the son too, right? And certain asset go to son too, right? So when the will goes to the court, court issues one notification asking for any objection anybody has in that on that will, right? So if anybody has that objection, they will have to put that objection into the case, okay? And court will decide that whether that objection which has been raised by the person is valid or not. Just to give you a very good example, in terms of a few years back, one of the big lawyers of recognized lawyers of India, and mother passed away. The mother said that all my assets will go to my elder son. Okay, elder son and my elder daughter-in-law. My younger son, or the daughter-in-law should not get anything from my assets. Okay, so that will was challenging. It was a very big amount in real estate investments and everything. So younger son went to the court, and the battle was there for 1 year, 2 years. Okay, so but ultimately the court decided, no, you may be saying everything is right, but the will is genuine. So court will look into the terms of genuineness of the will. Even if there is any objection, they will see whether the will was made by a sound person. Very important. Who are the witnesses? So you will have to take a witness into confidence. So if the witness says yes, it was signed in my presence, the person was of sound mind, then the objection which has been raised maybe may not be entertained by the court. So it may take time. There would be dispute. It may take time because it may delay the process of entire asset passing on to the legal head. It may get delayed, but the fact and every circumstance of every case has to be studied. So even court asks for who are the legal owners of the asset, legal beneficiaries, who are the family members. All the information is shared by the court. And court, if there is any objection, the court will decide how it should be with that asset.
Okay, Oscar. Oscar, I have one question. How do you handle the ancestral property that you inherit, and how do you handle that in the will? Do you really have the right to decide?
Yeah, I think before I would actually also put one more thing on this. When does the property become ancestral? I think that is where we should start from. Yeah.
Right. So now, there are I would say two thought of school which is there in the market. I would say. Now, what is ancestral property? So ancestral property is something which changes hand at least for 3 generations. So it goes from great grandfather to grandfather to father, and then comes to the son. So if it has changed 3 hands, then it becomes ancestral property. Now, in India, before the Hindu succession law, which was brought into 1956, there were a lot of custom tradition which the people used to follow. Okay, and it's very interesting, so people and there was different custom was following different tradition, different customs and everything. Okay, so to just bring consistency in everything, the Hindu succession law was brought into picture. So Hindu succession law clearly states how the property will devolve to the legal. Okay, now once the property devolves from father to the son, okay, and the transmission has been taken care, it is no more the ancestral property. Okay, it becomes the property of the son, and it is a self-acquired property. So if it is a self-acquired property, then he can will the way it is. Okay. Now, even there is a lot of confusion in terms of people, but even there are 2 judgments of Supreme Court which are contradictory. So one Supreme Court judgment said that yes, ancestral property cannot will. So if it is an ancestral property, the thing is you can't put into the will. But if it's not an ancestral property, you can put into the will. So when I say you cannot put into the will, means automatically the next generation become the owner of that asset. The second judgment which came of the Supreme Court, which says that ancestral property becomes a self-acquired, those specifically said that if the succession has taken place after 1956, after the Hindu succession law come into the picture, the ancestral property is no more into the picture. It becomes a self-acquired property. You can will it. The only issue arises if the property is acquired before 1956 and the succession happened before 1956. Then at that stage, we'll have to factor that how the whether it will be ancestral property, whether it can be willed or not. So we'll have to factor that. So otherwise, after 1956, ancestral property concept has gone. Everything, if the transmission takes place, it is not anymore a joint property between these siblings. It becomes a self-acquired property, and you can devolve to the next generation as per your wish in your.
Okay, I'll take up one question from here. I think I see Balwick India. Can a register will also be amended, or a new register will can be created as many times?
Right. So if you are creating a registered will, so if you want to make an amendment, so let's say any amendment to that will, you don't want to write a new will. When I say amendment means we are not writing a new will, but we are making certain amendment. Let's say you have said that my property should devolve equally between my 2 kids. Now you want to change that, and let's say 90-10 or whatever. You can just say that what we call it is a codicil. Amendment document is a codicil. Prepare a codicil 1-pager. Whatever amendment you want to the original will, registered will, you put into that document. The only thing is that the codicil also need to be registered because the original will was registered. So you need to even register the codicil whenever you make that. Now, second question is if you're writing a new will. So if you're writing a new will, everything in from start to beginning, then it overrides your registered will. So even if your new will is not registered, even if it is unregistered, it will override your registered will. There is no doubt about that. So many people think it is registered, again the new will have to register. No, it will override your registered will. And as I said, register doesn't give you any benefit except for two things: that one, that the will is not tampered. So if you foresee any dispute, you can register it. Or second, if the will is misplaced, the family can get a copy of the will from the register. So that's the only benefit of the register. Otherwise, it doesn't give you any benefit.
Okay. Another question I have is that in a will, when we when there is a rule defined for a real estate, and when you go for the mutation as per that, why does people still ask for a no objection certification from the other possible beneficiary? I mean, that's something which we have seen. It doesn't happen in other finance asset classes, but when it's a real estate, for before mutation, they would still say, okay, it's fine, you have a will, but still we want a no objection certificate from others.
Correct. So I will tell you, Sachin. In certain states, as I mentioned, at least in Bombay, Chennai, and West Bengal, the probate of the will become mandatory as per the law. So if you want to pass on the real estate form or transmit the register in the name of legal heir, you have to get the document probated. So in case of probate, there is no dispute because it's a court order, court stamp, right? So nobody can dispute that. So the registrar will register the property in the name of legal heir. The other state, now let's say in Delhi, the probate is not mandatory under the law. Okay. So when you go to the registrar with the will or without the will, so they will always ask, because they will not know whether this will is final or not, right? So they will always ask who are the other legal beneficiary, whether they have any objection or not. You give them that list, let them give the NOC. So if somebody wants to raise any objection, at that stage only they will raise that objection. So there is no dispute at a later stage to say that this property is not properly registered. So that's the process in most of the other states where probate is not mandatory.
Can I ask, I have one question, maybe I will ask to Mr. Atulji. So, two things. One is under the LRS investment that you're talking, how easy is it to just use your LRS and just go offshore investment, or will you have to take some prior approval before you start making an investment abroad? Point two, what happens to the incomes that you are generating from an offshore investment? If it is taxed there also, is it subjected to double taxation, or the laws that we have in India for short-term capital gains or long-term capital gains do apply to it? So if you can, probably just help on that.
Sure. So to answer your first question, Ashish, it's actually fairly easy to send money up to the quota that is allowed, which is $250,000 per person per year. And that per person quota applies to or is available for a minor as well. So if you have a 3-year-old son, that son also has $250,000 allowance to be sent out. Within that allowance, there is no approval required. And you can just go to the bank and fill a couple of forms and send the money out. So it's fairly easy now. Collectively, $20 billion by Indian families are being sent abroad collectively in a year, which was about $1 billion only 4 years ago. So that number has come to 20 billion, and since that number went up quite sizably in the last 4 or 5 years, we were always worried, and in fact we were telling always, we believe, I say this, that look at it as a privilege, that it is allowed for you to kind of take money out. It's not an entitlement, because it can be taken away as well. So and it has been, the limit has been reduced in the past, when the RBI in 2013 wanted to control the outflow. It was misdirected because at that time only collectively $1 billion was going out anyway, so they were not going to achieve by reducing the limit much. But now the numbers are much larger. So that's why we encourage people to use their quotas and get the money when the entitlement is there. So that's on the first part. It's very easy. No approvals, nothing required, and people are doing it. Second part is, of course, you have to find a way to manage it well, right? Which is where a lot of our work comes in. That sending money abroad is is very easy, but if you send it to a bank account, you really earn zero interest, because the bank accounts give you no interest, as you know, in dollar terms, right? In some other currencies, hard currencies, they actually charge you fees as well, so negative interest rate. So the money needs to be managed well, and with well managed, you can generate 8, 9, 10% return. That's not a problem, but it needs to be managed. On your second part, the taxation, you almost have to look at it as your investment in India. You don't have to, in most cases, you don't have to worry about taxes outside India, because, for example, a lot of the investment is done in Singapore or out of Singapore, where there are no capital gains or dividend taxes. So you can easily assume that there is no global tax on the income that you're generating, but there is India tax that you have to pay, because you are a resident of India and your global income is taxable in India. So there is no double taxation, but there is taxation in India. Now the rule on taxing that income also is fairly clear. The debt rules are very similar. 3 years holding period, it becomes long-term capital gains, 20% with indexation. On equities, it doesn't become long-term in 1 year. It becomes long-term in 2 years, because it is treated at par with, it's not a STT paid equity that you are buying, because the 1 year long-term taxation rule applies for STT paid equity that you have bought on Indian exchanges or mutual funds. So, it has a different rules, but in 2 years it becomes long-term, and debt is very similar. So, but no double taxation, but you have to file taxes in India on the realized gains, of course, not on the unrealized gains, on the realized gains. And some people sort of do get confused to say that, look, we will pay taxes when we bring the money back to India. That is not correct. The money is in your account, and if you have sold a stock that you bought, or a mutual fund or whatever, and if you made realized gains, it needs to be appropriately taxed on your tax statements in India.
So in this, even the currency differential will not be taxed, right? So assumingly, hypothetically, you have invested $100,000 US, and you get like $1,000 US as your earning. But probably when you send away the money was like 73, when you get back at 76. So there will be no taxation on the currency differential.
Yes. So you have to compute your capital gains, Ashish, in foreign currency. Once you compute your capital gains in foreign currency, then you have to convert that foreign currency gain into INR. So there is a specific rule provided that you in fact get a double dip. In one is you get that foreign exchange fluctuation as well benefit, and second, indexation as well for shares and mutual funds.
I get it. So one more question, Atulji, in your portfolio allocation that you showed in the very second slide, there is no, I don't see anything that you talk about things called the gold bonds that the government of India issues, where you can actually get the same amount of gold irrespective of the price. And two, there was no allocation for which most of the Indians end up doing is buying property for the escalation on the capital value as well as maybe rentals as revenue earnings. So both of the aspects are not there in the pyramid that you showed. Any reason for that?
No, I think not any particular reason. See, the gold we do consider in the alternative or the market neutral bucket. So there is an alternative bucket. If you go in that, there is one allocation to gold, depending on what level we are comfortable with. About 3 to 5% of every portfolio, we insist that you put in gold to have non-correlated stream to equity or bond market. So gold is generally covered. Why? Because gold is available in a securitized form now very easily. Now the real estate generally, Ashishji, one, of course, Indian families are significantly overweight in real estate anyway, right? So and this, we are showing a more liquid portfolio, the securitized portfolio, not the hard asset portfolio. But the real estate has a role to play. But in fact, as we would agree that in Indian portfolios, actually it's probably too much today than the need to be introduced. So I agree, as an investment, some money should go to hard asset, but I think the the liquidity benefit of your investments, people actually tend to underestimate. So that's why traditionally 80% of savings, Indian households generate $400 billion they generate every year, additional savings, and 70-80% have been going in gold, physical gold, and physical real estate, which actually is not right. I mean, it's the least productive deployment.
Yeah, and also to probably add to what the traditional has been the old generations, I would say. I mean, like, I would be probably a part of it as well. Where it was a major consumption source for parallel economy, right? Now with the younger children coming out on a very new thinking format, a longer investment on mutual funds or stocks would probably bring up more tangible results into their portfolio. So yes, I think succession plan wise, people like me are thinking different. Maybe investment wise, people like Sachin are thinking different. So Sachin, over to you. I mean, other questions, please. Thank you.
Mr. Atul, just wanted to have your opinion as in today's current circumstances for corporates, what avenues do you really advise for them to invest in their surplus, especially if equity is not on their mandate? What are the good, because the debts are really now giving very poor returns. So what would you recommend them for parking their surplus money?
So I think, Sachinji, so world over, the debt investing. So I agree that if you take the equity out, I mean, the large pool that you have surplus should go into fixed income. Now, world over, the fixed income is invested not in a fund format, but actually directly investing in bonds and looking at the credit, so that you can understand that credit. You can hold it to maturity if the interest rates move in a negative direction, or if it moves in your direction, then you can sell it and book capital gains, etc. as well. So I think in India that thinking is coming and should come over the next few years, where the corporate should look at not just AAA, because I think that's not helpful, right? I mean, you can't have 100% risk aversion and say that anything that is non-AAA is bad. No, we have had bad accidents in 18, 19, 20. Mutual funds were a bit kind of, I would say, sleeping on the steering wheel, and there are lots of accidents, but a lot of cleanup has happened. So I think there is appetite in thinking about credit, thinking about good companies that have solid balance sheets, very, very manageable debt equity ratios, solid promoters. Lots of them are owned by private equity funds like Sequoia and Norvest, etc. So giving those companies as debt is definitely the right sort of risk-adjusted place for putting money. And there the yields are not 3 to 4, but it could be 8, 9, 7, 8, 9 as well. And now again, for individuals, we do that in a like I said, in a MLD format. So as you know, with MLD, if you convert it, the same bond, into a market-linked debenture, then it becomes long-term taxation after 1 year, and long-term taxation being 10% for individuals. Because they need that tax advantage. For companies, I mean, depending on their tax situation, whether they are MAT or they're paying 20% or 25% taxation, they could choose either direct investing in the bonds or MLDs, depending on their tax situation. But I think that needs to get opened up, and it is opening slowly.
Okay, thanks. I'm just picking up
on this thing. Sorry, Sachinji, only on this thing. Just continuing from where you left. Sachinji has a lot of money to park. So, what is, for the benefit of our viewers? I mean, like, what is the minimum investment that one can be to be a part of venture capitalist investment that you are also putting in a kitty? So normally people associate large investments with venture capital. So is there a way that you can be able with small portions be a part of the funding of a new thought process?
So Ashishji, the AIF fund, right, the alternative investment fund in India that are used for investing in venture companies or raising venture capital fund and investing in the company, has a regulatory minimum of 1 crore. So 1 crore is unfortunately the regulatory minimum for AIFs for clients to put money in. I mean, of course, there is a different kind of venture investing that you could directly invest in companies. The very young venture, by definition, means very young companies. They are not gone through, and when they actually have, let's say, when they have profits, when their unit economics is proven, etc., the valuation goes up and they become called private equity investment, right? So the venture and private equity, the difference is that venture is sort of very early stage. So you will have companies that you may be able to. So once you're not investing in a fund, if you're investing in a fund, there is no choice. The minimum investment is 1 crore. Outside the fund, directly investing in the company, I mean, depending on what the company's needs are. So a lot of clients invest at 25, 50 lakhs as well. So there is no real minimum, but I think 25 to 50 lakhs coming early. You will have to come early because if the company's valuation is 100 crores, then you're not really going to get anything for 25 lakhs. But if the company is 3-5 years old and has not kind of got the institutional funding, then you could get 1%, 2% of that company at 50 lakhs or thereabouts as well.
So what is the CAGR for AIF right now?
What is the
CAGR? I'm like cumulative growth rate that is happening on AIF.
So you mean the returns?
Yeah, the returns, yes.
Yeah, so the target returns are anywhere between 16 to 20% because you are taking significantly higher risk than public markets because the money is locked in for a longer period in time, and because these are younger companies, you need to really give time for them to deliver value to you. So typical venture capital investing time horizon is 8 to 10 years. So you invest for 8 to 10 years, but you do have the chance of generating 16 to 20% compounding over 10 years, which is actually not a bad return by any stretch of imagination. I mean, it may look very similar to public markets of 12 to 14%, but 16% compounding, as you know, the power of compounding is huge. So for 7 to 8 to 10 years, if you're able to compound part of your investment at that rate, it's actually not bad. And especially with the today's day and age, that's why I spoke about the importance of private market. But there is an opportunity at every business level where technology-driven business models are disrupting those businesses, and some of the VC funds are doing a good job of picking some of those businesses, but they will need to be stayed with for 7, 8, 9 years, 10 years for you to realize full value. But the target return has to be 16 to 20%.
Sajanji, to you, please.
Sure. I think we are now nearing the closure time. I think otherwise the number of questions that
you can take, sir, then we'll close the session. Maybe if there is on the chat box, if any more questions are there.
Yeah, I see another one on a similar line where Paryushan is asking what is the minimum investment required in MLD with AAA rating?
Yeah, so a lot of these are kind of specific issuances done. So the minimum rating, minimum investment can be thought of as 30 lakhs. Okay. 20 to 30 lakhs is the minimum investment.
Fine. I think we'll put an end to the Q&A for today's session. But I just want to know that if our viewers wants to get in touch with you guys, what is the way out? Or if you could just, share an email ID or the contact person detail with whom they can get in touch with. I think then our viewers can directly take it up with you guys.
Absolutely.
Yeah. If one of you would like to just highlight that.
Yeah, may somebody can share the screen and put the email ID if it's possible.
Oscar, you have it on your document.
Yeah, I will do that. I will.
Yeah. In the meanwhile, Sajanji, may I take the opportunity to thank both Oscar and Atul in the meantime. So thank you, both our esteemed panelists. I mean, it was really, really captivating knowledge, and we are all bound to it, to the information that's come. And I think we need to have more session on this because both it is showing opportunities to earn as well as sensibilities to conserve. So I think we will have more sessions with you going forward. Thank you, Oscarji. Thank you, Atulji, for being here for this session for Rata and all the attendees. Rata is in constant endeavor to bring such nice and informative programs to you. In case you have any other specific requirements on programs, please do let us know. And for the benefit of any society, it is always better to have a strong membership. For those people who are not enrolled, I request you may please enroll as members. And at the other side of team, we will continue to bring more interesting programs for all of you. With that note, and I thank you, Sachinji, for being the lovely host as ever you are. And thank you both, sir, for Atulji and Oscarji for being here. And with that, we close this show. Thank you so much.
Thank you.
Thank you.